RVD, the average in dollars, gone in 4 months, and then watch it slip away through your fingers. Unfortunately, investors lose fortunes by overlooking the hidden pitfalls and believing the myths about DSCR loans. Today, we're going to break down the costly missteps, share real-world horror stories, which will be personally mine and some that I funded, and give you the direction that you need to become an insider, to protect your portfolio, gain knowledge, and also help you make those right decisions when you're trying to decide whether to use a DSCR loan or a conventional loan. Let's just start out. If you're new to the channel, please subscribe, share. I talk about DSCR loans, real estate investing, ground up construction. I am also a real estate investor along with a mortgage broker with Nexa Lending. DSCR loans, really quick, debt service coverage ratio loan. These are for investment properties. They are not for your primary residence. How you qualify for DSCR is very simple. 1, credit score. Have to have a credit score of 640 or higher. Of course, the higher your credit score is, the better off you are. 700 and above, you're going to get best rates. 2, the property has to appraise and it has to show some type of cash flow. It's off of a 1004 form, or excuse me, 1007, which will be scheduled rents. If you are in the short-term rental like Airbnb, then they can be prepared on the side from the appraiser. Lastly, closing in an entity or your personal name, your preference, but most people close in an LLC for protection. But know this, you still have to personally guarantee the loan. One person in your entity, whether it be yourself or another partner, as long as they've got 20% or more in ownership, has to actually guarantee the loan. So guys, let's get into this week's topic. Losing $50,000 on a DSCR loan. It happens more frequently and if you've been in this space for very long, you would know that there's certain things you can't pass up and there's certain things you just, okay, the deal that I'm talking about, and I'm just going to go into the real world, is it was a multifamily purchase, and this is tied into the DSCR world, did not do an inspection. So when I'm working with home buyers, I'm transferring over or transitioning to that are buying their homes for their personal residence, I always tell them, do not skip the inspection process. Same concept for a DSCR investment property. You don't know what you're getting into, and to pay the $500 or $600, maybe it's a little more, a little less, for that inspection is really protecting your assets. Because when the appraisal comes, the appraiser is not an inspector, so he or she could potentially find things that are considered health and safety, and that will slow down a deal for sure, but they're not going to find all the nuances. Maybe there's some problems with the HVAC system. Maybe there's a problem with the roof. Maybe there's a problem with the flooring. This individual was getting this property because they were looking to rent it out to Section 8. It's supposedly already been qualified through Section 8 and been approved. But after he bought the property, he found documentation that basically said the property wasn't ready, and all the things that were wrong with the property that would have been found in the inspection were found in the Section 8 report. So without doing the inspection, without checking the Section 8 report, he basically lost his down payment in this deal. He had to buy the deal because he couldn't back out at that point. It was already too late. He missed his window to inspect the property and then come back to the sellers. He bought the property in another state from where he lived, which we do that all the time. I get that. But he didn't have any infrastructure put into place to where he could actually get quotes from local general contractors or whoever he was going to use to get the work done. So he was scrambling to really get this deal done. And then he closes and then finds out that he can't even rent it. So he literally, for, I think it took nearly 4 months, if I remember right, couldn't rent the property, couldn't rent it privately, couldn't rent it Section 8. So that tells you that there were some serious troubles there to where he couldn't rent. So he's making a mortgage payment of $1,200-1,300 a month on something that's not producing income, all because of the front end piece, doing your homework and doing your due diligence. And what came back on the actual appraisal for the scheduled rents was right in line. He could charge, if I remember right, it was $2,600 or $2,700 a month. His mortgage payment was only $1,300. So he'd be cash flowing right out of the chute, $1,000 minus property management and putting money aside. He would be cash flowing some decent money. But he dropped the ball when it came to getting the inspection. From the pictures that he saw from the listing and talking to the seller's agent, even though his agent negotiated for him a 15-day inspection period to where he could do the inspection and then come back with any type of changes or price reductions that he was looking for to get the work done, which would have been ideal. But that didn't happen. So is it a $50,000 mistake? Right now it is, because that's $50,000 that he's put into this deal. And I need to follow back up and figure out how much in construction costs and repairs he had to do. I know at one point it was north of $15,000, but I'm not sure. I just wish that sometimes when you say something to somebody multiple times and he's being told by multiple people, that they listen, because that is a big mistake. $50,000. It's not good. So I digress. DSCR loans, they're no different than buying your first home or another home. You still have to do the steps to make sure that you're buying an asset that is, 1, solid, 2, going to be able to perform, and 3, there's no hidden issues. And if you do that, are you protecting your asset? Yes. Can other things happen? Yes. But at least you're hedging on the side of safety versus just willy-nilly it. And that just doesn't make any sense to me whatsoever. The story here is this: whether you're buying your house or you're buying an investment property, do the inspection, pay the money, $400-600, figure out what's going on, have an inspection period, make sure you know that house is decent, make sure the house is being taken care of. And if it has issues, you walk away. Because the other piece of this that's in here is you got to make sure your DSCR ratio is solid. Because if it's not, and you have a problem like this gentleman did on the front end, to where you can't rent the property and now you got to start paying the mortgage, how are you going to support the bills going forward? You can't keep on putting $1,300 a month into this thing without renting it. And if it's only going to rent for $1,300, you're losing. So again, look at your DSCR ratios. Make sure you're at 1.25 and higher. Don't get creative with your financing. I was watching a video this morning as I was getting ready, and this individual was a mortgage broker telling investors that an interest only on a DSCR loan is a good way to go if you can't hit your coverage ratio. That's crazy. 1, you're not paying down your principal balance. 2, you're basically saying, I'm okay to continue to lose money on this deal for the next 5 years, whatever it is. And then what do you do after that? Once that interest only or that ARM adjusts after 5 or 7 years, what are you going to do? You haven't been paying down your principal. You're only paying interest. The bank is the one that's winning on this. You're losing every single month. Why do we get so far away from understanding a ratio on these deals? 1.25 and higher is king. Why do you want to buy a deal that is going to lose money for you? Makes absolutely no sense. And I understand, guys, when you do the schedule of rents with an appraiser, yes, sometimes the actual lender will take the lesser of the two. But if the appraiser is telling you that it's only going to come in at $1,000 and you're at 1,500 and it's vacant, you better go double check your numbers, because ultimately that's going to cause some heartburn for you. And three, now you're locked into a loan. It might have a prepayment penalty of 1 year, 3 years, or 5 years. Now you're locked into a loan. And so if you refinance it, rate and term, or did a cash out, you're paying a prepayment penalty. So know your numbers, guys. Understand where you're at in the marketplace and do your due diligence up front. It's critical. It's crucial. And if you've got a property that's cash flowing and you're looking to do a rate and term to pay off a hard money loan, or you want to do a rate and term or cash out to get yourself a better rate, go for it. But make sure you don't over leverage yourself. Keep it below 75%. There are some lenders out there, guys, that'll go 80% on a cash out refi. Higher rates, if you can qualify 1.25 and higher, take a look at it. It may work for you. But if you do not do your homework, you're putting your hard-earned cash, like this gentleman's $50,000, at risk. And if you're not getting help when you're asking questions of your mortgage broker or of your realtor, feel free to reach out to me. Am I going to know everything? No. But I'll definitely help you, point you in the right direction. All right, guys. I hope you guys have a great Thanksgiving. Stay safe, stay healthy. I'll see you guys on the other side.